Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. 𝗵𝗲 𝗁𝗁, your host. Thanks as always for tuning in. It's really my privilege to do these episodes. And I want to say thank you also to our new YouTube subscribers. The number keeps rising, and for that, I'm grateful. And one of the great privileges of doing this show is that I get to meet and learn from great thinkers, people who have devoted their lives to finance. And in this case, he's a statistician with a keen interest in finance. His name is John Dobelman, and he is a professor of practice in statistics at Rice University and director of the Master of Statistics program in the School of Engineering. He also works with the Center on Computational Finance and Economic Systems, which is a fascinating project of bringing, computational finance to the financial sector, and it's at Rice, so it brought him to my attention. Now, he also has a new book out. It is called A Random Walk to Nowhere, which I've just read, and it is a classic, particularly regarding the history of what you might call financial economics. And in New Zealand, we would say it takes no prisoners. So anyway, John, before I keep spouting off about you, welcome to the show. It's a great honor to have you.
Thank you, 𝗵𝗲. I really appreciate it, and I appreciate Brian for letting us be a part of this production. And it's really great to be to be with you. I was going to have my publisher dial in today, but we were told there were some technical problems with that. I would point out that the reason we're in the statistics department, which is in the engineering school at Rice. And the reason for that is because statistics is the language of science. And the term statistician was a term used around, I'd say first used in the 1920s to be a security analyst. Okay. Security analysts were called statisticians at that time. So if you got a statistician job at a brokerage, you would be doing securities research. So it's kind of fun to be a statistician in the modern sense of the term, as well as the historical sense of the term.
Yes, and this book, A Random Walk to Nowhere, if people are not aware of that term, he is assessing the efficient market hypothesis, and it is a critique. And when I say takes no prisoners, he really seeks to be direct about it. And in some ways that makes it more enjoyable. It's a bit more polemical, maybe. I'm not sure if you like that term, but you said in the book, you say we don't want to have sour grapes, but we also want to speak forthrightly about it. So for those people who are not familiar with the term, and anyone who works in finance or has gone to business school has heard of the efficient market hypothesis. Now, but what does it mean to you? How do you define it for your purposes?
Well, the efficient market hypothesis, known as EMH, is normally sort of composed of three levels of structure. First one is the weak form EMH. The second is the strong form EMH, and the third one is the total form EMH. And essentially, the three forms, the weak form essentially says that technicals don't make any difference if you're trying to trade and to make above average profit. So no amount of technical indicators, including price indicators, volume, MACDs or anything, or Elliott wave or GANs or anything like that is going to help you. And that was one of the concerted efforts in the 1950s to come against that with the random walk model. And that was came out in 1958, although it had its origins going back to 1900. And so that's the weak form. And then the medium strong form says that no publicly available information will allow you to make above average profits. So no amount of fundamental analysis will help.
Yeah, fundamental analysis of publicly available information.
Publicly available information will avail. So the best you can do is to hope for average market returns. And then finally, the strong form is where not even private information, not even 𝗵𝗶𝘁𝗃𝗀𝗃 can make money using private information, although we have lots of examples in the book where that actually happened, especially in we had some senators that were trading on inside information because, of course, they were exempt from security laws for many years.
You mentioned that. And until about 2010, was it, or recently that
I think it was 2012 that
okay.
They were no longer allowed to do that. And so those are the three forms of the efficient market hypothesis. So essentially it says that there is no point in doing security analysis, because you can't do any better than buying the market portfolio and getting that 10% average return with dividends over long periods of time.
Yes, and that to me is the real crux of the issue. And you say in the book, okay, if this is all true, and what's the point of doing fundamental analysis? Why bother? And who's going to turn the lights out, basically? Who's going to be the last person doing any research, right?
Well, there were many of failed trading outfits discovered that the real way to make money is to sell data.
Okay.
So if you can't really make money with your trading system, you can always sell data. That's where the Center for Research in Securities Prices data came from, CRSP. It started with the Wharton School econometric model, which didn't really work out very well, but they found out that they could sell the data, and they do a very good job.
There was another fascinating aspect to this book, which was that on the one hand, there seems to be this dogmatic loyalty to EMH among the let's say the financial academic community, at least. But on the other hand, on a day-to-day basis, professionals in finance, they go and do equity research. They really devote a great deal of their time to doing research. So it's almost like this, it's very confusing. You think, well, if we don't believe, if we think markets are so efficient, why don't we just all buy ETFs or index funds and be done for the day, right? So people are not matching their actions with the theory, perhaps. Why is that?
The dichotomy between academia and practitioners has always been great. The practitioners have been on the cutting edge of like discovering alpha factors and things like that. I don't know if your listeners
I'm
know
not so
about
familiar
alpha
with that term. No.
Oh, well, this is where, the seeking alpha term, where you're trying to come up with factors that provide outperformance
in the capital asset pricing model. So you want to above an expected return, given the beta and the variability, whatever, in the stock. But so
right, and by the academic theory that that excess return is always zero. But and so everyone's seeking alpha. If you do a Google search on seeking alpha, you get millions of hits.
Of course. Right.
And that's because everyone is seeking alpha. The academicians essentially put all of the researchers into the arbitrage category, where if the price is too high, arbitrageurs will come in and sell until the price gets lower and until everything gets to the current market price.
Yes.
So it's but there is that dichotomy, and most of the academic researchers, when a lot of them, when they discover stuff, I mean, look at Markowitz and 𝗵𝗁 and French. They started the dimensional funds. They all start their own mutual fund when they come up with something that is significant. And dimensional funds is a big fund family now and has billions and billions under management. And essentially, this is the efficient market hypothesis portfolios, and that's what are sold in that particular fund.
what about, and well, I spoke with a retired finance professor who is the author of the textbook of the Chartered Alternative Investment Analyst Association, or the 𝗂�υ program. And his name escapes me right now. He's been on the show, but we'll put that in the show notes, just goldnewsletter.com/podcast. And he said that he sees the efficient market hypothesis really as akin to physics, just what would happen in an ideal world. But we learn this ideal world to understand the departures from it in the real world. How much merit is there to the efficient market hypothesis just as a thinking exercise?
I think it's a great thinking exercise. I mean, the picture, on the cover of the book, we got Palpatine there.
Yes.
And the whole point of the Star Wars analogy is that the efficient market hypothesis is like the Death Star in George Lucas' original Star Wars movie. And that it's unassailable, it's big, you can't attack it, it's impervious to attack, and it does what it's designed to do. And that's a really good model for the efficient market hypothesis. Markets are pretty efficient in general, but they're, what happened in Star Wars is, there are pockets of inefficiency that can be exploited, and these pockets change over time, and you have to be agile in your trading program in order to seek those out. But it is possible to make a living doing this.
Yeah, so the gentleman's name is Donald Chambers. So he is an excellent professor who's been mentoring me as I grow my own business. But as you say, it does seem to be difficult to show any kind of counterexample that really upends the EMH, right? So, of course, we see people getting alpha returns all the time, and yet it doesn't seem to have much impact. Why is that?
Well, first of all, the book is not is the EMH true or not? That's not.
That's true. That's true. Right. Yeah.
We say over and over again, we talk a lot about tests of the hypothesis and why you can't even test this hypothesis, because it's a multiple hypothesis testing problem for you statisticians out there. But the reason why there are so few counterexamples is because the markets are fairly efficient. And that's why the average, I forget what the statistics are right off the top of my head, but the number of mutual funds that outperform just the S&P 500 index in any one year is usually less than 40 or 50%. And doing that for more than X years in a row is really difficult. You have outliers, of course, which in statistics, outliers are most people throw out outliers because they don't like them. But in our work, we can't throw out the outliers. Warren Buffett, Jim Simon, Renaissance Technologies,
yes.
Some of the other ones that are making money year in and year out. These are out there. And then you have millions of individual investors and other little funds that want to do this, but the large funds, by the time you get of a certain size, it becomes really hard to find the values out there as far as Benjamin Graham defined the value stocks. Stocks that are truly undervalued. It's harder and harder to find those. We tell the story in the book, or Ed tells the story in the book, our co-author of, he was with Service Corp International since I think 1970 first as a vice president and then as a director, and he was in charge of the finance committee. And he had a finance professor come to him and tell him that Ed was saying, gosh, our book value is like 10 times more than the stock price right now, and our liquidation value is 20 times the stock price. And what is that all about? And the finance professor says, well, the market knows something you don't. And Ed said, well, I guess I'm going to go out and buy some more Service Corp. And he did. And of course, he did very well with Service Corp. And, but most of the time, you're not going to find those sort of things unless you're very careful looking.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hi, I'm Brian London with this week's CEO interview, where we interview the CEO of one of the Discovery Group companies. And the Discovery Group, of course, is the sponsor of the Gold Newsletter podcast. I have the great pleasure of talking this week with Frederick Bell, who is one of the newer members. His company, Elemental Royalties, is one of the newer members of the Discovery Group. And I had talked with Frederick before the company came public, as the Discovery Group was just getting involved, and was very excited about what was going to happen. And a lot of it has happened already. They've come public on the TSX Venture. The symbol is ELE. And a couple of keys to why I was excited about the company. One is Frederick's involvement. He's one of the up-and-coming young people in the industry where the Discovery Group has identified his expertise and his demonstrable ability to put together an incredible group of royalties in a portfolio. And second, the key distinguishing figure of elemental characteristic of Elemental Royalties portfolio is its tremendous focus on producing royalties, which is something that most of the none of the new royalty companies coming out other than Elemental have been able to achieve, to have so much of a producing interest. And in fact, Frederick, your percentage of producing royalties is greater even than Franco-Nevada, which I think is pretty amazing statistic at a very, very small fraction of the market cap. So with that introduction, can you give us a kind of an overview of your strategy, your royalty portfolio, and where you are right now in the process?
Absolutely. Thank you very much. I really appreciate being here, Brian. And I think as a high-level overview, we just started trading on Thursday last week, and we have assembled a portfolio of 6 royalties, 5 of which are over producing assets. And I think that gives us a net asset value in terms of producing assets of about 98%, and we're 90% plus weighted towards precious metals as well. And I think that does really 3 things from the outset. Number one is it does what all royalty companies, what you really want from a royalty company, which is it diversifies your risk.
Yeah.
You get that risk, that revenue spread across different assets. And I don't think it was, there probably isn't a better example than recently with COVID. Different operations in different jurisdictions, some having more restrictions than other. And for us to be starting life as a small royalty company, but more diversified than a mid-tier miner, gives us that lower risk from the outset. We've been cash flow positive from day one of setting up this company all the way through to today. I think the second aspect of it is that people always say the hardest part about putting together a royalty company is getting good quality royalties over producing assets. And I think if you look at our portfolio from the outset, we have demonstrated from a standing start an ability to do that, and not, in competitive processes always, quite often acquiring them sort of, off the market directly with the vendors. And for your Canadian listeners, we have royalties over 𝗬𝗏𝗃 and Premier Gold. So good quality, public listed companies investors will be familiar with. And then I think the last aspect of having producing royalties that's so beneficial is, take the current gold price environment. When you're an explorer and you're 8 years away from development, the gold price today might be very helpful for sentiment, but it really matters where it is in 3 or 4 years' time. For us today, every month, every week that goes by at these gold prices increases our revenue demonstrably. And when you're a royalty company like us with very low fixed overheads, that translates straight through into higher revenue.
Yeah, great summary. And one of the reasons, well, I mean, all those reasons add up to the fact that royalty companies typically trade at a significantly higher multiple in the market. So it's a great opportunity. It has all those advantages. You don't have the operational hassles. You have a much higher profit margin. And of course, you are, with gold and silver prices just rocketing higher right now, you're directly exposed to that. I think a key then is the fact that royalty companies are so much in demand, and royalties in general are so much in demand. It's a highly competitive area. So I was amazed that you were able to get these royalties. Could you describe some of the key ones you've acquired and why you were able to get them, whereas the other royalty companies out there that are beating the bushes were not able to find them or were not able to do those deals?
I think that if I demonstrate, maybe if I answer that by taking one or two examples of royalties that we own. And so there's one royalty that we have in Australia that actually used to be owned by Carlton Breweries. So for anyone who likes their beer, that's Foster's beer. And they've owned that royalty in Australia since the 1990s. So more than 20 years now. And for us, that was a great acquisition because it's in the heart of the Eastern Goldfields of Western Australia. We paid $500,000 upfront for a royalty that its last published resource was just under 2 million ounces on a mine, again, that's been operating for more than 20 years in the heart of the Eastern Goldfields. And so you could never do that with a company in the mining sector because they would know the value of it and it just wouldn't transact on those levels. And then I think also one or two of the other royalties we bought, two came from Yamana Gold, one came from 𝗂𝗗𝗁𝗂, which is now part of Barrick again. And I think in those cases, in one of those cases, we actually approached the company and they were not aware they owned the royalties. So we had to sort of, I think we had to send them their own press releases from 4 or 5 years ago.
Wow.
And the thing is, in a big company, turnover of assets, turnover of people, a royalty that isn't producing at the time is easy to go in the bottom drawer and sort of be forgotten about, much like some people's stocks. And so I think in those cases, for us, we really went out and we didn't do investment bank-led processes. We went out and we hunted down the orphaned royalties, the unloved third-party gems, and we were able to negotiate on those directly with the owners and transact. And I think that real focus on finding third-party royalties on good quality assets and being able to do it at good prices, that's what's enabled us to go from just an idea 3 years ago to listing last week in a very successful oversubscribed fundraise. And actually, I think we're now in a position, with more money, more revenue, and ability to use our equity for the first time. So it puts us in a position now as a listed company where we're better placed than ever going forwards.
Well, let's talk about that just briefly as we start to run out of time. But how much cash do you have right now? What are your plans? And I'm guessing you're going to remain aggressive on the acquisition front.
So we will have about net 13 million Canadian dollars post the repayment of a loan on the last royalty. We'll have access to an acquisition facility of approximately up to $20 million US. And then we have an ability to use our equity for the first time that really we didn't have as a private company.
Right.
I think that's such an important aspect to understand because we're coming now to the market and we're being able to revisit some of those royalties we saw when we were private that were $5, $10, $15, $20 million and that were really material acquisitions for Ascend. And as a private company, much harder to access capital. And for us now, those are royalty opportunities that we can go back to, and we can actually close some of them without even necessarily going back to the market. And when you add to that the fact that we're cash flow positive, and again with the current gold prices even more so, it just puts us in a really good position going forwards to be able to execute on some of those opportunities. And I think what we said, what we do say to people is that we're new to the market, but we're not new to the royalty space, and that's absolutely fundamental. Because it does take time to build up the network, the contacts, to hunt down the opportunities, to put the pipeline in place, and then to know today, okay, who are we going to go to talk to? Which royalties really would fit us now and are attractive opportunities? And I think that's where we are today.
Well, Frederick, very exciting. You have now cash. You have now, as a public company, currency with your public stock. You have the ability to execute even more so, but you're already cash flow positive, which very few out of the gate royalty companies can say. And you are just out of the gate, yet to be discovered, trading only days as we speak. And this interview is part of the process of really raising your profile to the investing public. So those listening to this is an early stage opportunity, a chance to get in perhaps before the vast majority of the market discovers this new Discovery Group company. Frederick, thanks so much for your time today, and thanks for updating us on Elemental Royalties.
Hey, thanks, Brian.
Yeah, one of the as you say, the book is really a work of history. It describes the evolution of how we got to with EMH being so strong. And I still remember almost 20 years ago when I got out of high school, I was just 17 years old at business school in New Zealand. And we had an American finance professor out there, and he would just drill into it, us. Efficient market hypothesis, all information is embedded in the price. And that's why it's been very strong in my thinking and just the way I've understood finance from that time. And you describe business studies or business schools as the softest of the soft sciences, which I must admit that as someone in business school, I find this, just somewhat
You're
accurate.
in a modern business school. You're in a modern business school.
Okay.
In the business school prior to the Pearson report and the Carnegie reports back in the 40s, it was extremely soft. And they wrote the report and said that, hey, these business schools need to be much more rigorous. And so that sort of brought about the revolution in financial economics. And you wind up with martingale theory now being taught at the PhD level in business schools, which is a very advanced mathematical concept. And you have that, but so that's one thing that happens.
Well, the reason why I bring this up is that you note that business schools have propagated this largely, and that for a long time, many university presidents and academics in general didn't see business schools having a place at the university. And I have triplet uncles. One of them is a president of a university. Another one is a professor of philosophy. And they sympathize with that view, to be frank, that what is business even doing at university? But you note that the economic weight that the revenue stream associated with business schools has overwhelmed that sentiment. And but do you believe business schools have been to the detriment of universities?
I'm not going to say yes or no to that. I will tell you that I'm a business school graduate. I graduated from the Jones School with an MBPM, which was Master in Business and Public Management, which was a precursor to the MBA. And back at that time, it was the Jones School of Administration, which later turned into the Jones School of Management, and then is now the Jones School of Business. They keep trying to figure out they're an A school or a B school, and stuff like that. But when I was, I thoroughly enjoyed my time in business school. I was an engineer, electrical engineer, undergrad, and so, I didn't find anything intellectually disappointing at the MBA school. I enjoyed it. I mean, my professors, George Grinius and Dwayne Windsor and Ed Williams, I mean, these guys were gods. And they were really quite amazing, and you had to work your tail off in order to succeed, as you know, because you're at the Jones School now.
I am. And there's just so much to say about business schools in general. It's a fascinating area. My own personal view is it is a fact that business schools serve a different purpose to other schools at universities. and they're much more oriented towards, let's say, getting a job or finding an entry into the corporate ladder, whatever it may be, and much less so on the intrinsic value of just education or learning for learning's sake. And that manifests in many ways. Now, you don't pull any punches, and you say that when you finish off, you say, we come to the point of considering what has the image, has its effect been on shaping the intellectual landscape of the financial world or the finance world. And your concern is that those who seek to limit or give a sobering perspective regarding the EMH, they are the victims of a malicious criticism and suppression, actually. And you say that these tactics actually are elements of fraud. So why is this tribal approach to academic research in the financial field?
As we point out in the book on many occasions, none of the players intentionally went out to intentionally intended to be a fraud in any way. This was a genuine effort to discover something about the markets. The problem was that given the development of the so-called science at the time, you had to make these unrealistic assumptions in order to get some kind of model that was able to, you could calculate tractability. And that started way back in the 60s. The sort of the adversarial role or the suppression of alternative research, which was, a lot more 20 years ago than it is today, because so many people realize that, maybe this thing is not as powerful as, not as omniscient or not as omnipresent as we expected. That's gone down, but the way it developed was, from men and women who had a good desire to explain things, and then once they got traction, they had to do what it took to maintain the orthodoxy. And so and when my co-author, who was there at the time, I was not there in the 60s.
Sure.
But he was there in the 60s, and he got all of his papers rejected. And tenure was not approved. And that was the case in many, many cases. Matter of fact, when I interviewed I got my PhD in 2004. I quit my day job as an engineer because I wanted to study trading. And so I went to PhD school in '98 to get my PhD, and I got out in 2004, and I was trying to find a good job, and so I was interviewing at the Jones School, and the dean at the time said, "Well, I understand you've outperformed the market," and I was so innocent, I said, "Oh yes, it's great." And then I didn't realize I just shot myself in the foot on that interview.
That your capacity, or the hubris that you had apparently to think you could outperform the market, was a disability, an Achilles heel.
Yeah, and that was just a mere 20 years ago. So that just shows you that, it's still kind of a stigma if you portend that it's not exactly all there. But I think it's gotten a little bit better now for alternatives researchers.
Yes.
And so I'm hopeful that that's going to continue to grow.
Yeah, one aspect, as you say, is the way that there's maybe a poo-pooing or a dismissive or glib approach to alternative views that is not conducive to discussion or actually refinement of our thinking. And I do still see that sometimes, actually. Now, let's say someone finds your story compelling and says, well, there's more to markets than the EMH. And one of the books recommended in this book, maybe if this is kind of, maybe it's for the educated layman, if I can put it that way. I'm not sure many people in general would want to read this, but people who have an interest in finance, yes. Definitely people in business school and with an interest in finance, yes, they would get it. But it's easy reading, but still there's some thoughtfulness in there that, and some nomenclature maybe. Now, you recommend Models for Investors in Real World Markets by your co-author, Edward Williams, the late Edward Williams. And that came out, where have I got? I'm just looking at it here. About 20 years ago.
2003, I think.
2002, or November 2002. So
yeah.
Is that still a suitable follow-up to this one?
That's a good book. It's a great book if you want to learn about capital asset pricing model, the institutional aspects of securities markets, something about accounting, and some stochastic models for stock price growth and options and stuff like that. So if you want kind of an overview in that way, it's still a very good book, and there's a lot of philosophy in that book that's quoted in this one also.
Yeah, and one thing, I hope I'm not giving all the secrets away from your book, but I don't want people to think that this is all negative, right? That it is true that there's some criticism, or you raised plenty of concerns. And I did find that the comments on business schools to be comical, such as your story about how the Jones School at Rice grew and enjoyed support because the other schools basically were recipients of the overflow, you might say, of the Jones School's success. But you said there will always be pockets of inefficiency which can be exploited for those stout-hearted enough to look for them, right? And so your message, I guess, is that don't let the EMH dissuade you from being an analyst, from doing research and seeking to beat the averages.
Yeah, or come up with a portfolio that matches whatever benchmark you were looking at. I mean, look what happened with cryptocurrencies.
Yes.
Cryptocurrencies came on the scene, 2010 or whatever that was?
2009, yeah, but they only really got attention in 2010.
Bitcoin was pennies, and then it jumped, it just had this huge run up to 12. And around 2020. It
maxed at 20,000 in, I think, 2017, yeah.
Yeah, but I remember it went to 10 and it crashed, and then I wasn't paying attention, and the next I knew it was 20,000.
Sure.
But the point is there's all kinds of inefficiencies in that market. There's exchange arbitrage. There's all kinds of, because now there's hundreds of cryptocurrencies, so you can do all kinds of arbitrage. And I know it's getting harder to find those pockets of inefficiencies in that market, but that's still an example of an open market for traders.
What about the fact that if you go to the key exchanges in Latin America, such as the Mexican exchange or the Colombian exchange only lists about 70 companies in total. And
a lot of countries are like that.
Yeah, and so one of our accounting professors made the claim that the disparities in returns are much greater across those companies than you would find in the United States, that some perform much better and some perform much worse. And is that a signal that there's less efficiency there? Do these emerging markets offer what you're talking about when you refer to cryptocurrencies?
Well, I don't know if I'd relate them to cryptocurrencies. I would relate them. We talk about information and regulation in the book also, and this is a gap kind of a issue on accounting procedures for international accounting, and there are then there's political, as you know, political differences between the countries, and so there are ways to. Imagine trying to trade in People's Republic of China. It's very difficult. to get a fair shake there. And I don't know about Colombia, but I would
Yeah.
assume there are emerging markets inefficiencies in that particular place too, as well as Mexico and Ecuador and Uruguay.
Yeah. So, but do you then see use in referring to this term of efficiency, or markets being more or less efficient? That's still a handy, just a handy term to use.
Well,
Yes,
they've
no?
been trying to come up with a measure of efficiency. If it were efficient in a physics sense, there would be a measure of efficiency.
Yes.
So that's something that people are still working on. I don't think the verdict is out on any kind of a measure of efficiency, which would be nice to see what the relative efficiency of Ecuador is to Colombia.
It seems so difficult because obviously markets are becoming less and more efficient, or they have, more information available, or more people participating all the time. So it's not really a set or static level of precision. So now, as I said, the book has a lot to say, and particularly for people who are interested in the academic side of finance, the business school world, plenty of history there, which to me that's why I was so stimulated to read this. And the positive seems to be that, yes, there are inefficiencies. Are you sympathetic to those? Now, we've had obviously technical analysts on this show. Are you sympathetic to those who even would challenge the weak form EMH?
Well, I think we've seen a lot more challenge to the weak form in the last few years with some of the anomalies that have come out.
Sure.
We talk about anomalies in Chapter 7. This is a whole book on anomalies, calendar anomalies and arbitrage by 𝗵𝗁. And a great reference source and lots of beautiful trading examples. I mean, look at gold today. What, we're down 80?
Exactly. That's the thing that all these technical analysts, if you could determine precisely when the turn would be, you'd be in a much better position, right? So that's why
I don't even need to be precisely. I just want to get 80% of the move. 80% of an 80-point move on gold would be pretty awesome.
It's still a mystery to me how these people really extract that or work that out, but it has been obviously, of great interest lately because of the sharp rise and then fall just in a matter of days. So,
no, I'm a firm believer in coming up with market models that are based on technicals that, have some predictability to them. I mean, that's what I look for all the time, as well long-term models as well as short-term models.
Let me bring up your website here because, so the website for the Center on Computational Finance and Economic Systems, which you said is a stand-in site right now while you're working on a new one, but it is COFES-rice.org or .org. That's 𝗀𝗵𝗂𝗄𝗋-rice.org, and we'll put that again on the show notes. And this is, in my mind, a great option for basically bringing a lot of the themes that you talk about together and in a way that's applicable or practical for this era. So I encourage people to check that out, and they have events and they put out a newsletter. So there's a lot of activity there. It's interesting to follow. Now, do you want to give a plug for any other book you've got in the works, or any other way people might want to follow you?
No, I really enjoy the Gold newsletter, and that's a really great site. And I do a lot of work on technical analysis, but I do a lot of work on fundamental analysis and quantitative portfolio formulation. And I've worked for various hedge funds as a consultant and had my own trading company for many years in the Woodlands. That's how I put myself through grad school. And so this is the latest book we have. So, if you want to pick it up and learn something about the history of financial economics, then you can certainly do that. There are a lot of kind of interesting anecdotes in there if you want to learn some more learn some more about that. And I don't have any
That's
other
good.
things besides that.
We're good to go. Yeah, the book is A Random Walk to Nowhere. And yeah, plenty of anecdotes, particularly the co-author who's passed away now, but he lived through this, as you said. And so a lot of firsthand accounts. So John, thanks so much for your time. We appreciate it.
Thanks, Fergus. I appreciate it.